Welcome back. Holding around that 18,500 mark for the Nifty. Let's talk about a couple of individual stocks. Transport Corporation is the stock on our radar. Saw decent revenue growth, almost 9% in the fourth quarter, but we did see a decline in their operational performance, and as a result of which the net profit fell by about 5% as well. Vineet Agarwal, who's the managing director of the company, joins in now. The stock down 1% now, but down about 18% from its fresh 52-week high as well. Vineet, thank you for joining in. Just wanted to understand, the fourth quarter, the revenues, no problem, 9% jump out there, although a little lower than the mid-teen sort of growth that you've been posting in the past. Wanted to know, in particular for the Seaways division in FY24, what's the kind of outlook that you have? Mainly because freight rates have fallen drastically over the same time last year.
Yes, hi. It's always a pleasure to be here. Last year we had a very high base. The shipping rates were quite high. Shipping rates for us are not really too much dependent on the international markets, but more on the domestic markets. And the domestic market, the rates were pretty high. I guess it was a rub-off from the international markets to some extent. In this year, as you know, that the global markets are not doing too well on the freight side, but it does not affect us too much. So we've been able to maintain our margins. However, our direct correlation in our Seaways business is with fuel. And fuel prices over the last quarter, especially in Q4, did come off a bit, and that brought down some revenues as well. But Q4 last year was a really bumper year. So I guess that high base had some impact on this year. But I'm very confident about the future with the kind of opportunities we're seeing right now.
Mr. Agarwal, when you say you're confident about the opportunities, I wanted to speak about your operating performance because FY23 margins came in at 15.7%. You had guided for 17.5% to 18%. So when you talk about not being impacted by global factors, what led to this margin decline that you saw on a YOY basis? Was it completely because of a high base? Because you did not meet your guidance here. And what is the outlook for FY24 in terms of margins?
Well, our guidance for the entire year and not specific, we don't give a specific quarter-wise guidance, was a 10 to 15% increase on the top line, which we exceeded. We did a 16% increase on the complete year and a 10 to 15% on the bottom line, which was about 12% increase. So in that sense, we have met the guidance that we gave. So perhaps the Q4 was a little off because of the, as I just said, the high base effect. But again, going forward, our guidance for FY24 remains at 10 to 15% on the top line, a little muted than last year, but 10 to 15% on the bottom line as well.
All right. So 10 to 15% on the top line and 10 to 15% on the bottom line is what we should work with on a broad guidance sort of band, right?
That's right. Correct.
Okay. Let's talk about, the volume outlook. In the last year, if I look at the overall TEUs handled, they've increased by about 2.7%. Full rakes that you handle in the train business, that jumped drastically, about 51.7% jump out there is what we saw. Shipping volumes, you've said in the conference call that you don't reveal. We just try to get a band of, what sort of volume growth are you penciling in this 10 to 15% revenue growth across all verticals?
So you're absolutely right that the rail vertical, as in the rail type of businesses that we're doing, has had quite a dramatic jump. And this will continue because what we believe is that the next stage of growth is going to come from multimodal logistics. Now, about 10, 12 years ago, almost 100% of our business was road transport. Now it's about 2/3 of our business, which is rail as well as sea, or that is coastal shipping. And, that's the direction the country is also moving into. If we really need to bring down the logistics costs of the country as a whole, we need to change the mode of transport. So we've invested heavily into these segments, and we're seeing very good opportunity in terms of growth. So multimodal logistics has clearly two benefits. One is that it is a little cheaper on a net door-to-door basis. And sometimes, the other aspect is green logistics. I think with every company talking about ESG goals, we are seeing that if you are able to bring down the carbon emission by changing the mode of transport, we would see a dramatic shift in terms of how carbon emission is also happening in the country. And this is a big focus for us as an organization because we do fall into that category where we need to really be very conscious about how we are going to deliver growth in the future and with the right quality growth.
Okay. Mr. Agarwal, in that case, when you're talking about future growth, what would the revenue mix of TCI be likely going forward? Right now, it's 49% from freight, 34% from supply chain, and 17% from seaways. Would that alter in a significant way?
I wouldn't say significantly. I think changes like these take a longer time. They are more subtle. And we will see that we would get to perhaps in the next 3 to 4 years, almost a third of each business contributing to the revenue. So it's a mix that's going to happen in a few years, but not so dramatically.
Well, if the revenue mix changes to a third for everyone, then that would change your margin profile quite a bit, despite your revenue profile not changing too much as well. Largely because a third of the revenue is coming in from shipping, which has nearly double the margins, average margins of your company. Would alter your margin trajectory to say around 16-17% as against the 11-12% that you've been doing?
That's hypothetical, but we would love to get there, but certainly it's not so easy. Shipping margins in the last 2 years have been, I would say, a little bit on the abnormal side, and we have had some benefit. So it might taper off a bit. Also, you get sometimes certain when volumes are being dealt with, margins don't increase as fast as they should. So I would think that it will definitely creep up, but not to that extent.
That is on margins going forward and the revenue mix. So what was the revenues from cold chain business this time? You had targeted 80 crore rupees. Were you able to meet it? And what is FY24 looking like?
So no, we were not able to meet that. We've achieved what we achieved last year, which was about 60 crores. And one of the reasons was that we saw a lot of churn in the commerce business, which was also using a lot of cold chain. And as you guys know the industry much better. It is going through a lot of ups and downs, and we wanted to actually churn out some of those customers, and which we have done. And the profitability is maintained even with that change in revenue mix. Going forward, we are now looking to definitely achieve the 80 crores target for this year.
So 80 crores for FY24. You said profitability metrics have been maintained. What sort of operational metrics do you look at when it comes to the cold chain business? I mean, is it currently in further investment mode? Are the margins similar to what you do in your other businesses? Are they higher? How do they work?
Cold chain businesses typically is a combination of both cold movement as well as warehousing for cold chain. So warehousing, essentially pallet-based warehousing, and customers either want short-term warehousing or even long-term. For example, in the mango season, a lot of the juice manufacturers actually buy all the mango pulp now in season and then store it for the full year so that they can supply it for the full year. So that is a little bit of a long-term storage. And then there are guys who want very quick movement. And then there's other segments like pharmaceuticals and chemicals, etc., that also require cold chain. So the revenue mix really depends upon many factors. And it's, sometimes it's transportation, sometimes it's a combination of both warehousing and transportation. So no specific idea on, how we generate the revenue, but yes, broadly, this is how it is.
Okay, last question quickly before we let you go. You incorporated subsidiary TCI Middle East Logistics. What was the rationale for this? And going forward, what kind of capex number are you looking at?
So going forward, the investment into some of the subsidiaries around the neighboring countries from Bangladesh, Nepal, Sri Lanka, and then now to Middle East is essentially directed towards follow our customer strategy. So we have a number of customers that are importing or exporting from these locations. And that's exactly why we have done this, because there is a demand to provide an end-to-end solution. So it's not necessary that we're going to do freight forwarding, but it's more important that we are able to provide a door-to-door solution to clients. And this is again going to the policy of how we can bring green logistics to the country. Incidentally, we've also tied up with IIM Bangalore to open a supply chain sustainability lab, which is again doing a lot of research on how to bring about green logistics.
All right, sustainability is the need of the hour. We will monitor that as well as your growth numbers that you've been giving us. Vineet, thank you so much for joining in. Wish you good luck for FY24 as well. With that, we'll simply do a short break, come back, get you more on the markets and individual stocks.